Everyone thinks the AI boom is a story about chips. It isn't. It's a story about electricity. Every AI chip that NVIDIA builds needs enormous, around-the-clock, carbon-free power to run, and there is almost none to spare. So the real bottleneck in artificial intelligence isn't the silicon. It's the grid. And one company owns the single scarcest asset in the whole build-out, nuclear power plants, which it is now renting to big tech on 20-year contracts. That company is Vistra. Last quarter it earned $1 billion, with record results, and it has signed Amazon and Meta to long-term deals for its reactors. So how does a power company become an AI play, and is the stock still cheap? Let's run the numbers. Start with what Vistra actually is, because it's bigger than people realize. It is the largest competitive power producer in America, around 44 gigawatts of generation across natural gas, nuclear, coal, solar, and battery storage. And it doesn't just make power, it sells it, directly, to about 5 million retail customers. That combination matters. Vistra both generates electricity and retails it, which lets it hedge the wild swings in wholesale power prices that wreck pure generators. So this is not a sleepy regulated utility with a guaranteed return. It's a merchant power company that competes in open markets like Texas and the Mid-Atlantic, and that freedom is exactly what lets it strike its own deals with the hyperscalers. Now the heart of the story, and it's nuclear. Vistra owns about 6 gigawatts of nuclear power, Comanche Peak in Texas, and a set of plants, Beaver Valley, Davis-Besse, and Perry, in the Mid-Atlantic, which it picked up by acquiring Energy Harbor in early 2024. And these reactors are extraordinary assets. They run at 95 to 98% capacity factors, meaning they produce power almost every hour of every day, all year. Here's why that's suddenly priceless. An AI data center needs power that never stops and never emits carbon. Solar and wind can't promise that. A nuclear plant can. So the asset that the market wrote off for a decade as old and unsexy has become the most valuable kind of power on the grid, and Vistra owns a fleet of it. Let's make the demand concrete, because the scale is staggering. A single large AI data center can draw as much electricity as a small city, continuously. And the hyperscalers are building dozens of them. The result is the first real surge in US power demand in 20 years, after 2 decades of flat consumption. The grid simply was not built for this, and new power takes years to permit and construct. So the hyperscalers are doing something they've never done before, signing 20-year contracts to lock up existing, reliable generation, and paying a premium for it. For a company like Vistra, that turns a volatile commodity business into something that looks far more like a long-term, contracted annuity. The scarcity is the opportunity. So how is this showing up in the financials? In records. For the first quarter of 2026, Vistra earned net income of just over $1 billion. Its ongoing adjusted earnings, the cash flow measure that matters, hit a record first quarter $1.5 billion. Revenue jumped to $5.6 billion. And for the full year, management reaffirmed guidance of roughly $7 billion in adjusted earnings, and that figure excludes the big deals still to close. There's upside layered on top. This is a cash machine, throwing off billions, right as its core asset becomes the most wanted on the grid. If you want the other side of the megatrend story, subscribe. Next we cross into healthcare with Novo Nordisk, the other half of the weight loss drug war. Now the deals that change everything, and they are remarkable. Vistra has signed about 3.8 gigawatts of 20-year nuclear power agreements with investment-grade tech giants, roughly 1,200 megawatts to Amazon at Comanche Peak, and about 2,600 megawatts to Meta at its Mid-Atlantic plants. And here's the genius part. Part of the Meta deal funds upgrades that add new capacity to the reactors, generation Vistra builds with essentially no capital risk of its own, because the customer's 20-year commitment pays for it. Better still, around 3 more gigawatts of nuclear remain uncommitted, a second wave of deals waiting to be signed. Each one is 2 decades of locked-in, high-margin cash flow. And nuclear isn't the only move. There's a second engine being bolted on. Vistra is buying a portfolio called Cogentrix, about 5,500 megawatts of natural gas power, for $4.7 billion, expected to close in the second half of this year. Why gas, in a nuclear story? Because data centers don't only need clean baseload, they need dispatchable power that can ramp up the instant demand spikes. Gas does that. Nuclear is the steady floor, gas is the surge capacity. And critically, none of that Cogentrix earnings is in the current guidance yet. So when it closes, it adds billions in capacity and cash flow on top of everything we just walked through. Vistra is buying scarcity from both directions at once. So who else is in this race? It's a small, fierce club. There are really 4 pure-play independent power producers fighting for the data center prize: Constellation Energy, the giant, now around 60 gigawatts after merging with Calpine, Vistra, NRG, and Talen. We covered Constellation earlier in this series. It made the all-in bet on clean nuclear. Vistra's strategy is different, a deliberate mix of gas and nuclear, plus that integrated Texas retail book. Together, these 4 own the merchant power plants in the deregulated markets: Texas, the Mid-Atlantic, California, exactly where the data centers are landing. It's a genuine arms race, and the prize is a 20-year contract with the richest customers on Earth. Vistra is right at the front of it. Now the question that decides the return, the price. Vistra is worth about $54 billion. It trades at roughly 17 times forward earnings, and under 11 times its operating cash flow. For a company at the center of the AI power boom, that is not an expensive multiple. In fact, here's the irony: Vistra is far cheaper than the chip and software companies it powers, yet without its electrons, none of them run. But understand what's been priced in. The stock has already re-rated from a sleepy utility to a growth name. A lot of the data center demand is now in the price. And this is still a capital-intensive business exposed to power and gas prices. The cash flow is real. Whether the boom keeps compounding is the bet. Let's put it together. On one side, the largest competitive power fleet in America, 6 gigawatts of nuclear running near full capacity, 3.8 gigawatts already contracted to Amazon and Meta for 20 years, 3 more gigawatts uncommitted, a 5,500 megawatt gas deal on the way, record cash flow, and a multiple cheaper than the AI names it serves. On the other side, a stock that's already re-rated, a capital-intensive model exposed to commodity prices, and a demand thesis that has to keep delivering to justify the re-rating. The franchise says scarce and contracted. The price says the boom is already partly believed. So where do I land? In my view, Vistra owns something genuinely rare, reliable, carbon-free baseload power at the exact moment the world is desperate for it. 20-year hyperscaler contracts turn a volatile commodity into a contracted annuity, and the uncommitted nuclear plus the gas deal give real, visible upside. This is one of the cleanest ways to own the AI build-out without betting on which chip wins. But respect the cycle and the price. Power is still a commodity, the model is capital-hungry, and the stock no longer trades like a forgotten utility. I'd own this franchise for the contracted nuclear cash flows. I just size it knowing the easy re-rating has already happened. The scarcity is real. How much of it you're paying for is the question. My base case for the next 12 to 18 months, more hyperscaler deals get signed, the gas acquisition closes, guidance moves higher, and the stock trades on the pace of data center power demand. Watch 4 signals. First, new power agreements. About 3.8 gigawatts signed, 3 more uncommitted. Each new 20-year deal is locked-in cash flow and fresh fuel for the stock. A dry spell is the first warning. Second, adjusted earnings versus guidance. A record $1.5 billion this quarter, about $7 billion guided for the year. Watch the guide get raised. Third, the Cogentrix close. 500 megawatts of gas, $4.7 billion, second half of this year, capacity not yet in the numbers. Fourth, buybacks and leverage. Vistra returns a lot of cash, watch the pace against rising capital needs. Upstream, Vistra depends on fuel, the grid, and relicensing its reactors. Downstream, it sits under the data centers powering the entire AI economy. The catalyst that lifts it, the demand surge and the next PPA. The one that breaks it, data center demand disappointing into an already re-rated stock. The AI boom is really an electricity boom, and Vistra owns the scarcest power on the grid, 6 gigawatts of nuclear running near full capacity, now rented to Amazon and Meta on 20-year contracts. Record cash flow, 3 more gigawatts of reactors waiting to be signed, and a 5,500 megawatt gas deal landing on top, all at a multiple cheaper than the chips it powers. The catch is that the stock has already re-rated, and power is still a capital-hungry commodity. This pairs with our Constellation deep dive, where the chips and software grab the headlines. These are the companies that keep the lights on. The bull case is the scarcest asset in the AI build-out. The bear case is the price you pay to own it. One stock, all the numbers, no hype. I'm Big Z, follow me, see you in the next deep dive.